Good afternoon, everyone, and welcome to our 2026 Market Preview webinar. Over the next hour, we'd like to share with you our thoughts on what happened in 2025 and critically, what to watch for over the next year. Now, before we get started, the usual logistics. Our content will occupy the majority of the next hour. However, if you do have questions, please submit them using the Q&A feature. If we do not get to your question during the allocated hour this afternoon, we will respond offline, get back to you. So please go ahead and submit those questions. Similar to past webinars, this will be recorded and uploaded to our YouTube channel. So if you are so moved to share with colleagues or committees, we encourage you to do so. As for introductions, my name is Greg Leonberger. I'm the Director of Research here at Marquette. If you have joined us for previous webinars, welcome back. I'm glad you could join us again. Joining me today are our lead analysts across the different asset classes we will cover. Frank Valli and James Torgerson will discuss fixed income. Catherine Hillier and David Hernandez will review U.S. equities and non-U.S. equities, respectively. And then we transition to the alternatives portion of this afternoon's webinar. Evan Fraser will lead the hedge fund discussion. Dennis Yu will cover both real estate and infrastructure. Then our private markets review will be led by Amy Miller on private equity and Chad Schaefer on private credit. Now, consistent with previous webinars, we start with the U.S. economy, but first, let's lead off with the good news. 2025 was an especially profitable year for investors. We have the fourth quarter results across asset classes on the left-hand side here, or really that's in the middle of the page. On the right-hand side, 2025 year returns. As you look across the different asset classes, U.S. equities on the top, non-U.S. equities in the middle, and fixed income on the bottom, all were positive for 2025. And we're going to explain what happened and what drove those returns, and also what to watch for in 2026 to see if we see the same return patterns over the next year. If we think about what we're watching for in the economy, after Liberation Day in early April last year, there were a lot of fear about either a recession or stagflation. And as the chart here shows, the odds of recession has fallen quite a bit. As we enter into 2026, the odds sit close to about 30%. So in other words, fears of a recession are not especially paramount as we start off the new year. And perhaps not surprisingly, because there's not a lot of fear about a recession, not a lot of fear about a slowing economy, expectations for rate cuts from the Federal Reserve are relatively little for 2026. That said, there will be a new Fed chair halfway through the year that may change policy just a little bit, but it's worth reminding everyone there that just because there's a new Fed chair doesn't mean that all the voting members are different. A lot of the members will be consistent. There are 12 voting members on the committee. If we think about broad macroeconomic variables, things that kind of catch the headlines and investors tend to notice at first pass, Fed funds rate, that's interest rates. We don't expect that to change very much based upon the last slide. If we think about change in real GDP, that's really economic growth. And we expect an uptick in economic growth from 2026 versus 2025. Unemployment rate and inflation are expected to moderate just a little bit. However, we do not expect especially noticeable moves in what those variables look like over the course of the year. So overall, we're optimistic going into the year in terms of economic growth, where we're certainly glass half full as it relates to an economic outlook. Now, as we transition into capital markets, we went into 2025 expecting fixed income to be a positive constituent of investor portfolios, and certainly that was the case. So, Frank, you'll start. James, you'll jump in afterwards. But Frank, maybe just start a little bit about what happened in 2025 and then spend some time talking about what you're watching for in 2026.
Sure. Thanks, Greg. So coming into 2025, the yield on the aggregate was 4.9%, which was a fairly good starting yield for the index. Positive returns were expected across most scenarios. We did see lower treasury yields and also tighter spreads, which generated a higher return than was expected given the starting yields. The ag was up 7.3%, and high yield was up 8.6%. Loans were up 5.9% as falling Fed funds rates lowered the total returns. And the standout for the year was emerging market debt. Dollar-based EM was up 14%, and local EM was up almost 20%. Yields generally fell throughout 2025. The front end fell as the Fed cut rates, although the back end did tick up a little bit due to inflationary fears and continued budget deficit. This ended the curve inversion and reintroduced term premium into the treasury market. Now, the big question on everybody's mind in 2026 is who's going to be the next Fed chair. Prediction markets are split between Hazlitt and Warsh. No matter which Kevin you pick, a more dovish Fed is expected. All in all, fixed income yields remain attractive. Starting yields are lower in 2026 after a strong 2025. However, they're still above long-term averages in most markets. Starting yields are going to be a good indicator of future returns. There's a very strong correlation between starting yields and the 7-year forward return. Starting this year, the ag has a yield of 4.3%. That's going to be a reasonable assumption of returns over the next 7 years. The reason why we picked 7 years is that's around the duration or time horizon of the ag. So it's a good general representation. But over shorter time periods, there can be a significant variance because that shorter period depends more heavily on what happens in terms of rates and spread movements. However, when we look at the variety of spread and treasury moves over the next 1 year, the majority of those scenarios, you are still going to see positive total returns. I'll now transition over to James, and he's going to talk a little bit about the spread environments.
Thanks, Frank. Appreciate it. So I'm once again here to tell you that spreads are tight. Spreads start 2026 at essentially the same level as they started in 2025. Outside of a 2-week blip where spreads were briefly liberated from these extreme tights, spread valuations continue to grind tighter across sectors amid strong demand for fixed income. The good news is that tight spreads reflect resilient corporate balance sheets and a pretty benign default outlook. The bad news is that spreads are still tight. After multiple years of significant outperformance of the lowest quality CCC high yield, high quality high yield led the way in 2025. While not on this chart, it's also worth noting that this dynamic was present and even more pronounced within leveraged loans. The outperformance of higher quality was due to increased stress and a concentration of defaults in the lowest quality of issuers. Dispersion between credit quality tiers increased in 2025 and is a trend that could continue as we move into 2026. Interestingly, this was only the third time in the last decade that double Bs were the top performing rating tier within high yield. If you've been perpetually overweight to quality, it finally paid off. However, double Bs have only posted consecutive years of outperformance 3 times since 1990. So, despite the increased dispersion, a repeat of quality outperformance would go against the trend. So, if quality is outperforming, then defaults are probably increasing, right? Wrong. Despite some large dollar amount defaults that grabbed headlines and created angst among investors, Tricolor, First Brands, more recently Saks, defaults actually moderated nearly 20% year over year in 2025. While high yield defaults did increase very slightly, they are well below long-term averages. Defaults in leveraged loans fell significantly, which was driven by an over 40% reduction in liability management exercises, which we have discussed in this webinar in the past. Overall, this led to a compression of default rates between high yield and loans and a broad reduction in the overall default rate. As we look towards 2026, defaults are not expected to increase meaningfully, providing some comfort for credit investors. Both high yield and loan default expectations for the next 2 years have been revised down, reflecting a more constructive outlook on credit. Resilient balance sheets and a lighter maturity calendar in 2026 and 2027 should set up for a pretty benign default environment. While defaults should remain low, we can't discuss credit without discussing the downsides. There is credit stress present, but it is primarily concentrated in a handful of the lowest rated issuers. It will be important for investors to be judicious when picking and choosing where and when they take risk. All that to say, don't be surprised if there are large defaults that come across the headlines. Barring a massive credit shock, it is prudent to keep in mind that these should be mostly idiosyncratic defaults and not reflective of the broader credit environment. Finally, as we look at some opportunities across asset classes and fixed income, one area which we've touched on here before is securitized credit. This remains an area of opportunities we head into 2026. While relative to the recent history of the asset class, yields in securitized credit have fallen and spreads are tighter. But compared to similarly rated corporate credit, securitized credit offers a yield premium and it also offers a premium from a spread perspective as well. Securitized credit remains a compelling opportunity in 2026 for fixed income investors. It can help diversify traditional fixed income exposures and provide increased income with the same or less risk as similarly rated corporate credit. Finally, wrapping up with risks and opportunities, these haven't changed a ton. Obviously, income generation is an opportunity in fixed income. While starting yields are lower entering 2026 relative to 2025, yields remain at attractive levels. If there are no significant shocks, income should help carry fixed income returns. Even if bearish scenarios are realized this year, there's still adequate cushion to protect on the downside. And as Frank mentioned, 2025 was the year of the return of the term premium. The steepening of the yield curve provides an opportunity to capture excess yield by moving farther out the curve, which is a welcome change from the past few years. And then, as I've just detailed, strong credit outlook. Fundamentals are resilient. Default outlook remains muted. And finishing up with the risks here, so the bond vigilantes. Bond vigilantes are back. We mentioned the return of term premium, but there's a reason for this. Major global economies are forecasted to run very large fiscal deficits for the foreseeable future. At some point, investors will demand additional compensation for holding long-dated bonds. This would put pressure on the long end of the yield curve. Not going to keep touching on rich spread valuations. You guys get the point. And then finally, wildcards. As always, there are many wildcards that could derail positive momentum in fixed income. Continued uncertainty around Trump's economic policies, increasing geopolitical tensions, and the U.S. fiscal deficit, as well as a new Fed chair, all could impact outcomes in 2026. These wildcards highlight the importance of a diversified fixed income allocation.
James, I think you said the best just a minute ago when you said income should carry fixed income returns. Spreads are tight, absolute levels of yield are high, not as high as they were going into 2025, but that level of yield coupled with the fact that we don't expect some large credit shock to the markets should make fixed income a positive component of investor portfolios for the next year. Now let's move over to equities, and Catherine, U.S. equities are on quite a ride. They took a backseat a little bit to non-U.S. equities this year, but still a really profitable year for this past 12 months. So help us understand kind of what happened in 2025 as well as what to watch for in the next year.
Yeah, thanks, Greg. So to summarize 2025, volatility was a theme throughout the first half of the year, emerging early in the year after DeepSeek challenged many assumptions related to AI development and the Trump administration announced a series of tariffs. But as the Federal Reserve embarked on a new rate-cutting cycle in the second half of the year, volatility largely abated and domestic markets proved very resilient. Following the strong post-Liberation Day rally, the S&P 500 continued its advance, gaining 2.7% in the fourth quarter. More notably, for the third consecutive year, the U.S. equity market posted double-digit returns as the S&P 500 and Russell 2000 indices gained 17.9 and 12.8% respectively. With this strength, many major benchmarks now sit at close to or at all-time highs. During the quarter, signs of broader market strength did support value-oriented equities across the market cap spectrum, as value indices outpaced their growth counterparts. Despite these signs of broadening out, the Magnificent Seven still contributed nearly 40% of the total return of the Russell 3000 in 2025. Further down the market cap spectrum, small cap stocks saw leadership from the most speculative corners of the market from April through October, which we discussed on our last webinar in detail. But November and December brought some reprieve as profitable companies outpaced their loss-making peers by 2.4% among small cap equities. Even with the strength across U.S. equities in 2025, a much less frequently spoken about asset class outpaced these indices shown here, as the Russell Microcap Index gained almost 23% last year. Now, considering performance by sector, unsurprisingly, technology and communication services led returns in 2025. While other sectors also tied to the build-out of AI advanced over 15%, specifically the industrials and utility sectors. In the fourth quarter, however, healthcare, a sector that had been much maligned in the beginning of the year, led and was the only sector to advance over 10%. This ties back to the outperformance of microcaps in 2025, as the microcap biopharma sector advanced roughly 46% for the year as M&A started to pick up in the space. With 3 consecutive years of double-digit returns, what might be in store for 2026? As of now, consensus estimates are pretty bullish, with most analysts expecting another year of positive returns for U.S. equities. Return forecasts range from low single digits to over 18%, with an average return forecast of about 10% for the S&P 500 in 2026. Modeling the average return, as we show here, the S&P 500 would achieve a cumulative gain of nearly 97% since the end of 2022, which marked the launch of ChatGPT and the AI evolution. Although another positive year would be fantastic, we also want to consider what returns would look like if the market took a breather, which is still very much a possibility when considering elevated valuations and concentration, as well as the geopolitical and policy concerns. If the market pulled back 15% in 2026, which is by no means our base case, the S&P 500 would still post an over 50% cumulative gain since the end of 2022, which really isn't too shabby. When I spoke about risks, I failed to mention the consumer. While the consumer appears to be in good shape, when you look under the hood, this is very bifurcated by income levels, with the highest income earners largely supporting the economy, suggesting the presence of a K-shaped economy. Based on the University of Michigan Consumer Sentiment Survey, the story also appears less positive. Consumer sentiment remains well below its historical average and weakened in the second half of 2025, but the equity market largely ignored this, as we saw with a historic rally off the April lows. So what happened to support the equity market? Part of the answer lies with corporate earnings. Although the Magnificent Seven continue to generate a significant portion of the earnings growth for the S&P 500, with CapEx spend among technology and AI-related companies a key underlying driver of the economy, the remaining companies in the index also saw strong earnings growth in 2025. This supports the signs of the market broadening out that we saw to close the year and is a trend that we expect to continue into 2026. Shifting gears a bit and not shown here, small cap equities are expected to see positive earnings growth in 2025 after multiple years of declines. If these expectations hold, which has not been the case in recent years, small cap earnings may outpace their large cap peers in 2026. But I do say that with some hesitation, as the story we've told before. If small cap earnings do finally come through, alongside the strength seen in the rest of the S&P 500 outside of the Magnificent Seven, markets will be well positioned for further broadening this year. Although the market showed signs of broadening out to close 2025, it does remain very concentrated. Last year, the top 10 constituents in the S&P 500 contributed over 50% of the return to the index. This concentration continues to pose risks to the market at any slowdown in CapEx spend or the AI narrative leaves the market susceptible to a pullback. But as we suggested on the previous slide on earnings growth expectations, there are opportunities outside of the Magnificent Seven that are starting to be appreciated by the market. Taking a closer look at the Magnificent Seven, and the chart on the left may be somewhat difficult to read, but just two of the Magnificent Seven were able to outperform the S&P 500 in 2025. Those two companies were NVIDIA and Alphabet, two companies that have benefited from the AI movement and have distinguished themselves with reported gains from significant CapEx spend and market-leading products. The chart on the right breaks out the semiconductor index, a key component of the AI value chain. In 2025, despite the strength of Magnificent Seven, semiconductors outperformed this cohort by roughly 5%. This helps support the notion that the market is starting to broaden outside of the major hyperscalers who are fueling CapEx spending and leaning into other companies that are reporting productivity gains and margin expansion from AI adoption, which also includes the mid-cap and small-cap companies. As earnings drives returns over the long term, we break down the composition of returns for the S&P 500 on this slide. Unlike what we will see in international markets, the story has not been primarily focused on multiple expansion within the U.S., at least not last year. Earnings growth, although concentrated in a select group of companies, as we mentioned earlier, drove the double-digit return for the S&P 500 in 2025. To support another positive year for U.S. equities, as consensus estimates predict, strong earnings growth that broadens out across U.S. equities will be key, especially as valuations in the market remain high. Taking a closer look at those valuations, U.S. equity markets continue to look expensive relative to historical levels. Although strong corporate balance sheets and continued innovation may help support higher valuations, this does still pose some risk to the market. While lofty valuations may not be surprising after 3 years of double-digit returns, a case may still be made for small cap equities relative to their large cap peers. Small cap equities have lagged large caps for the past 5 years, so relative to large caps, small caps may present a valuation opportunity within the U.S. equity market. And notably, small caps have not lagged large caps for 6 years in a row, so maybe 2026 truly might be the year for the market to broaden outside of the Magnificent Seven. We have touched on several risks and opportunities already, but to highlight a few, AI will likely continue to be a structural driver of U.S. equity markets, especially if adoption accelerates throughout the broader economy. We've already started to see markets favor those companies that report measurable outcomes from AI adoption. Conversely, the AI bubble narrative is a dominant theme among market bears who fear earnings will fall short of lofty expectations, leaving the market susceptible amid already high valuations and concentration. Back to some opportunities, broadening market leadership and earnings growth may underpin continued strength across U.S. equities, while favorable policy and a potentially more accommodative central bank alongside strong corporate balance sheets offers further support. Other notable risks include a potential economic slowdown if credit conditions tighten, inflation remains sticky, or cracks emerge in the labor market, especially at the historically high market valuations we have. While geopolitical uncertainty, midterm elections, and questions of Fed independence also present unknowns that may spur volatility in the market.
Thanks, Catherine. And this is not the first time that listeners are going to hear AI as a driver of markets, either up or down, over the course of 2026. And some of the themes are the same things we talked about the last couple of years, certainly the last couple of versions of these webinars about concentration and valuation. But if we do see broadening market leadership, that should be a strong support mechanism for U.S. equity markets in 2026. All right, let's move over to the non-U.S. side of things now. And David, for years, we've been saying the relative valuations of non-U.S. versus U.S. are favorable. And that finally played out in terms of actual returns in 2025. So looking forward to hear your comments on what happened in 2025, as well as what you're watching for, and if this can continue into 2026.
Yeah, 2025 was a banner year for non-U.S. equities. Several key benchmarks generated returns north of 30%, 30. These are the biggest gains we've seen since 2017. And that year, the EFI was up 25%, EM was up 37%. And beyond returns, there were additional similarities between 2017 and 2025. You had both years saw a weak US dollar, both had positive earnings growth, and both started the year with a wide valuation gap between US and non-US. So what happened in 2018 to follow 2017? While non-US equities sold off, they were down between 14 and 15%, and that was influenced by the Fed raising rates further. The US dollar moved higher, and then we had the deterioration of the US-China trade relationship. Now, I'm rooting against a repeat of 2018 performance, and in a couple of slides, I'll share with you our 4 key themes for 2026 as it relates to non-US equities. Before that, though, 2025 was such a good year for non-US equities, I think it deserves a couple more slides. So performance was strong, and it was broad-based. If you look at 12 of the 13 largest countries, they outperformed the US market. And if you move left to right on this chart, you'll see a mix of emerging markets as well as developed markets. And there's a mix of investment themes. AI helped boost Korea and Taiwan. Those markets benefited from that. But you also had sectors like financials, materials, and industrials help boost countries like Spain, South Africa, Mexico, and others. So very strong returns in 2025. Next, let's decompose these returns to get a better understanding of what happened last year and give us some insights into what to look out for in 2026. So we'll do this into 4 components. And the first component is currency. So the US dollar was weaker, so non-US currencies were positive, and that was especially true in developed markets where currencies accounted for roughly a third of the calendar year return. The second component was earnings growth, and that was positive, and that ranged between 3 and 9% year over year. The third component, dividend, added about 3% across non-US benchmarks. And the fourth component, valuation, this is the one that was the largest contributor to performance in 2025. And this was the result of increased momentum and a major shift in investor sentiment on non-US equities, and that occurred through much of last year. Now, as a result of this dynamic, multiples have moved higher for non-US equities. If we go back to the start of 2025, multiples were around the 55th percentile, which is close to average. By the end of 2025, for the EFI and the emerging market index, multiples are in the 84th and 89th percentile. So they are much more expensive than they were to start 2025. And when we look at this year, earnings growth is going to become more critical in terms of future. Now, with that being said, it's no surprise that earnings growth is one of our 4 key themes for 2026. The other 3 are protectionist policies, fiscal and monetary stimulus, and technological innovation. Now, last year on April 2nd, President Trump announced a sweeping package of tariffs that aimed to correct what his administration viewed as unfair trade policies. And then the following months, we had a lot of uncertainty with countries exchanging tariff threats back and forth. And it was very hard to keep track of where the tariffs were on a week-to-week basis. But as of right now, what we've listed is the tariff rates at the start of 2025 and at the end of 2025. And on average, tariffs have moved higher by 14% on an absolute basis. So we likely have less uncertainty around tariff policy today than maybe the middle of 2025, but uncertainty remains regarding tariffs' impacts on economic activity, both globally as well as the U.S., inflation, as well as company fundamentals. Now, connected with protectionist policies are the expectations around increased fiscal spending, especially outside the United States. And a key example of this is Europe and their pledge to spend 5% of GDP on defense. And this is going to be led by Germany. And historically, that country has been notoriously strict on its budget, but they've agreed to ease their government debt limits in order to spend on defense as well as infrastructure. And outside of Europe, you've got Japan's new administration, which is also expected to provide significant fiscal support. You have China, which is making targeted investments, both public and private. We'll talk about the private in the next slide. And so you have an environment in 2026 where fiscal spending is supportive as well as monetary policies. And those are good in terms of return potential for this year. Now, I mentioned that China is expected to increase both public and private spending, and much of that spending is being directed towards technological innovation. So similar to what has occurred in the United States, hyperscalers are allocating billions of dollars in capital expenditures. Now, there's additional similarities between the U.S. and EM that I'll cover in another slide, but the point is that U.S. is not the only AI game in town. They might be the top AI game in town, but they're not the only AI game. And in fact, Taiwan, South Korea, and China have been huge beneficiaries of the AI boom, and this is likely to persist. Taiwan and South Korea are integrated into the global AI supply chain, and China has accelerated the AI adoption around cloud computing, around e-commerce, and around industrial applications in an attempt to stay a global manufacturing hub. So should AI momentum continue, these markets are likely to participate and continue to benefit. Now, I mentioned that additional stimulus between U.S. and EM, or there's additional similarities, between U.S. and EM, and those relate to the benchmark concentration and contributions to return. Over the last 2 years, the top 10 holdings in the EM index have grown from 23% to 31%. Now, the U.S. is more concentrated at 38%, but the trend of increased concentration is similar. We've also seen the top 10 stocks in both markets account for a large portion of the benchmark's overall return. In contrast, the MSCI EAFE, the Developed Markets Index, has not experienced the same degree of concentration, nor has it seen a return boost as strong from the AI boom. So the takeaways here for me are that an AI slowdown would likely negatively impact both U.S. large cap as well as emerging market large cap. But a second takeaway is that developed non-U.S. markets can provide some diversification benefit away from that AI theme. Now, the last key theme for 2026 for us is likely the most important theme, and it is earnings growth. 2025 did see positive earnings across non-U.S. markets, but as I said before, valuations were a bigger component of the return contribution. With higher multiples, higher expectations, earnings will get heightened attention, and rightfully so. So the good news is that double-digit growth is expected in 2026 and 2027. The bad news is much of this is likely already priced in, and that creates a higher bar to exceed in terms of expectations. And if the market falls short of those expectations, it'll likely serve as a headwind to performance. Let's wrap things up with the opportunities and risk for non-U.S. equities. I talked about the fiscal and monetary environment outside the United States. We think those are supportive. Earnings growth momentum has picked up from 2025, turning positive and expected to hit double digits in 26 and 27. We'll have to keep an eye on that to see that that comes to fruition. We mentioned some of the AI themes that is helping not just the U.S., but also areas outside the United States, particularly in the region of Asia. In terms of risk, tariffs, there might be some more certainty around what's happening from a policy perspective, but there's certainly uncertainty around their impact on economics as well as company fundamentals. We talked about multiples increasing for non-U.S. equities, and what that does is it removes some of the downside protection that we might see. And then index concentration, we think, is a risk both from U.S. side as well as on the EM side of things.
Yeah, and that index concentration on the EM side is something that may not be at the forefront of investors' minds as it relates to emerging market indices, but it's a really important reminder in the how much is concentrated in AI with emerging markets as well. And again, that word AI or the letters AI will be a meaningful part of return expectations for non-U.S. equities in 2026. Clearly, it comes down to earnings. Multiple expansion is nice. It drove markets higher, but we really need to see sustained positive earnings outlooks that meets or exceeds expectations to move markets higher on the non-U.S. side of things. Okay, so let's move now to the alternative side of things. And Evan, I don't think 2025 could have been a better advertisement of a year for hedge funds, both in terms of returns across strategies as well as total assets under management. So I don't want to steal any more of your thunder. I'll let you take it from here.
No, you're right. I'm very disappointed 2025 is over because of how strong a year it was for the hedge fund industry in general. Here we can see that no major hedge fund index returned less than 7% for the full year, and spaces like equity long short, event driven, merger arb were up over double digits. Macro funds, you'll recall, had a challenging first half of the year amid all of that Liberation Day chaos, but many of those were able to right the ship in the second half of the year, particularly in the fourth quarter, and that index finished up more than 7%. And then finally, put right, again, a bit of a challenge start to the year. You can see the full 2025 return of that index was around 9-ish%. I'd say that's on the lower end of what we might expect given what the S&P 500 did in 2025, but certainly not an unreasonable figure. So all in all, an exceptional year for the asset class. And here we kind of drive the point home about just how strong 2025 was for hedge funds. So the blue line on sort of the left-hand side of these clusters is the HFRI Composite Index, kind of tracks the broad hedge fund industry. It just had its best year since 2009, up about 12.5%. The green line to its right is the Equity Hedge Index. 2025 was the second best year since the GFC for that index, 17+% return. Merger Arb in black also had its second best year since 2009. I could continue, but the point is very strong absolute performance. But what might be even more impressive is the relative performance these indices notched during the year. So you can see the S&P 500 return in orange at the right-hand side of these clusters. And you'll notice the differential between the indices and the S&P 500 last year was more narrow than normal. So Greg, if you want to go back to the last slide, I just want to say a couple of other things about this. So historically, the HFRI Composite Index, again, that's the one in blue, captures about 45% of market upside. Last year, it captured more than 70%. Similarly, the Equity Hedge Index typically captures around 50 to 55% of equity market upside. Last year, it captured 97%. It's an incredibly impressive year. And a similar story, again, can be told for a lot of these indices. So certainly great to see hedge funds perform well on an absolute basis last year, as well as relative to the broad equity market. Now we can go to the next slide. So 2025 was one of the strongest and most consistent years for long-short alpha generation in over a decade, with both long and short books contributing positively to overall hedge fund returns. So according to data from Morgan Stanley, global equity long-short funds generated positive alpha in 9 of 12 months in 2025. And the full year spread between performance of the top longs and the top shorts was more than 30 percentage points. It's the highest level on record, dating back about 15 years since when they first started tracking the data. And it reflects exceptional stock selection on both sides of the book, particularly on the long side. And to paraphrase the classic movie Field of Dreams, if you build it, they will come. As we saw, hedge funds built an incredibly strong track record last year and really in the last couple of years. So perhaps it's no surprise that allocators have, to a certain extent, come back to a space that was once asset class non grata, if you will. So here we can see industry AUM, hedge fund industry AUM that has climbed above 5 trillion for the first time. It's an all-time high. So reasons for this, I think in addition to returns, maybe a need for diversification on the part of allocators, some frustration with certain pockets of private markets is kind of fueling this interest in hedge funds. And we'll discuss kind of the implications of this trend in a couple slides. Really quickly on hedge fund positioning. So throughout last year, net leverage swung around a little bit and currently sits at about 55%. That's near long-term averages. Gross leverage, on the other hand, is now close to a decade high of around 215%. This suggests to me that funds are finding attractive opportunities on both the long and short sides of the book. Based on what we're hearing from managers, some of those areas of interest include AI enablers like semiconductor companies, both here in the US and in Asia, industrials and defense companies around the world, and even biotech, where we're seeing more generalist hedge funds starting to rebuild exposure after a multi-year drawdown in that space. So as we've discussed before, volatility is typically good for hedge funds as it creates a more attractive opportunity set and allows funds to act defensively given their lower net exposure. But when it comes to current volatility dynamics, I would say I have good news and I have bad news. And we can start with the bad news first, get it over with, which is sort of twofold. So first, the VIX is currently sitting below long-term averages. And second, even when we have seen the VIX spike over the last couple of years, it's reversed course and moderated more quickly than usual. That's what we're seeing here on this slide. And so, we haven't really seen those sustained periods of volatility that are so conducive to strong relative hedge fund performance. So that's kind of the bad news. The good news is on the next slide, which is that there is more than one way to measure volatility. So on the previous slide, we were just talking about the VIX. That is tied to the S&P 500, so it's a measure of volatility at the index level. But we can also look at the volatility of index constituents or single stocks, and specifically the spread between the two, which can be seen here. So what is this chart telling us? Well, it's saying that in 2025, not only was the volatility of stocks in the S&P 500 higher than that of the index itself, but it was higher by a wider than normal margin. So hedge funds can do a couple of things if this dynamic persists. They can put on popular sort of dispersion trades, which involve going short the vol of the index and long the vol of the constituents, or they can just enjoy a better stock selection environment given the higher levels of vol at the single name level. But either way, it creates some opportunities for hedge funds, particularly those in the equity long short and relative value spaces. So if that single stock volatility, certainly if that persists, that's a positive. Other tailwinds for the space include the extent to which hedge funds have been able to adopt AI technologies in their own processes. This makes pattern recognition and information processing much easier for managers. Additionally, as allocators look to kind of diversify existing sort of core direct lending, private credit exposure within their portfolios, there are certain hedge fund strategies that could play that role, certainly those in the credit space, of course, but also more niche areas of the hedge fund space like reinsurance and litigation finance could see renewed investor interest. On the risk side, we talked about those capital flows coming into the asset class, hedge fund industry reaching over 5 trillion in AUM. Certainly nice to see that hedge funds are having their day in the sun, but these flows could create capacity issues across the industry. So for instance, certain credit and RV managers can't get too big because of the nature of the trades that they have in place. We're already seeing some premier funds either soft closing or perhaps hard closing. I expect that to continue if money continues to flow into the space. One other risk I would point out is manager selection risk, kind of given the wide performance dispersion within the hedge fund universe. I suppose that's sort of always a risk, but just to contextualize this. So in 2Q alone, there was a 30 percentage point spread between the top and bottom deciles of managers within the hedge fund universe. and on a trailing 12-month basis, it's more like 50 percentage points. So the strong index performance that we talked about earlier, that's all well and good. But if you've selected subpar managers, you could see challenged returns from your hedge fund portfolio. So make sure you're picking the right managers. And to the extent that a consultant can help with that process, we are more than happy to do so. So I couldn't resist that plug. I think that's about it. Just want to reiterate the fact that 2025 was an exceptionally strong year for the asset class. And here's hoping that positive performance persists into 2026 and beyond. So with that, I'll turn it back over to you, Greg.
Thanks, Evan. And again, that assets under management number crossing 5 trillion is perhaps the best endorsement of investor interest in hedge funds. And at a very high level, they've done a really strong job of preserving capital and also providing upside to investors who invest in strategies that pursue asset growth over time. Okay, let's move over to real assets now. We have real estate and infrastructure to discuss. And Dennis, I think it's pretty safe to say at this point that real estate truly has found a bottom, that it bottomed in 2024. We've seen multiple quarters of positive returns now for the primary indices. So take us through what you're seeing in real estate and then carry it on into infrastructure, please.
Absolutely. As a reminder, private real estate infrastructure performance are reported on a lagged basis. So for the third quarter of last year, the NFI Odyssey Index has achieved a total gross return of 1.2%. This was all driven by income with flat appreciation. As a result, we are currently witnessing 5 quarters of consecutive positive returns. With further market recovery, we're in a new real estate cycle as valuation stabilizing and capital return to the space. Turning to fundamentals, net operating income growth is expected to be the primary driver of real estate return going forward, especially in an environment where cap rate compression is unlikely to do much of the heavy lifting here. Industrial stands out as the clear leader, both historically and on going forward basis. Specifically, forward-looking expectations move closer to the mid-single digits, reflecting strong lease renew spreads. Even in their downside scenario, industrial net operating income growth remains positive, underscoring the sector's fundamental resilience. Outlooks for multifamily and retail are both positive, but office remains as the troubled sector. Some of the assets are stabilizing, especially these high-quality assets. Sectors-wide growth is still challenged. Moving on to leverage, this chart highlights how the role of leverage has changed in recent years in private real estate. Under today's higher interest rate backdrop, leverage is no longer a reliable return amplifier, and performance going forward will be driven far more by asset selection, income durability, rather than pure financial engineering. In terms of sector outlook, we see steady rise in alternative sectors within core real estate. Exposure in the Odyssey universe to alternative has increased from low single digits to more than 13% today. The main drivers of this trend are persistent demand in data centers, self-storage, senior housing, these sectors with structural tailwinds from demographic shift and technology advancement. To summarize real estate, we're witnessing better opportunities in non-core and distressed segments, where dislocations and constrained financing still create attractive entry points. Meanwhile, sector and market selection are important, given alternative sectors now present strong fundamentals and diversification benefits. On the risk side, the office sector remains challenged. Construction costs are rising due to proposed tariffs and labor shortages. And lastly, the rising 10-year treasury rate continues to be the headwind for valuations as borrowing remains expensive. For private infrastructure, we see 2.3% quality return in the third quarter last year, with 10.3% return over 1 year and a consistent performance over a longer period. This indicates steady and reliable performance for private infrastructure, making it a very attractive option for investors seeking stable cash flow tied to inflation. Particularly, we see significant cash inflow into digital infrastructure in recent quarters, and we expect momentum will continue in the near term. This chart highlights how aggressively the major tech firms are investing in data centers and AI infrastructure overall. And one of the biggest challenges of data center expansion is demand for power. U.S. data center electricity demand is expected to be more than tripled over the next 5 years. And more importantly, data centers' shares of the total U.S. electricity consumption will go up quickly in the next few years. They currently account for roughly 4%, but it will go up to 12% by the end of the decade. That means more than 1 out of every 10 electricity produced in the US will goes into data processing and AI computation. To wrap up on infrastructure, on the opportunity side, infrastructure remains as a reliable inflation hedging, income generating asset class, and also with power demand surges from AI development, there's a growing need for energy generation and transmission. On the risk side, GDP-linked assets can be more volatile in a slowdown, and asset quality, operational execution remain critical to long-term success across the infrastructure sectors. With that, back to you, Greg.
Thanks, Dennis. And again, those letters AI will certainly have an impact on what the infrastructure market does in 2026. And circling back to real estate, to summarize some of the main points, 5 positive quarters of returns now, mostly driven by income. And as we look towards the next year, real estate investors in the core space should really expect the great majority of returns to be derived from income, and not much is going to happen on the price appreciation side of things. Okay, now we're on to private markets, both private equity and private credit. Amy, we'll let you lead off with the equity side of things.
Thanks, Greg. We'll start with a quick review of performance for the quarter and over the long term. Private equity and venture capital performance is as of the third quarter of 2025. For global and U.S. venture, those two segments continued their 3-quarter streak of outperformance, while the U.S. small buyout, which we define as funds of less than $1 billion, remained a consistent long-term leader. Broadly, private equity still performs well over longer horizons, despite quarter-to-quarter volatility, most specifically with growth equity in recent years. And this reinforces PE's role as a value-add source of returns and diversified access to less efficient markets. On the M&A activity side, in North America, M&A activity reached a record $762.2 billion in the third quarter of 2025. This is the highest deal count since the first quarter of 2022. After the second quarter hesitation tied to tariffs, weak confidence, and higher interest rates, sentiment shifted to risk on following the September Fed cut. Further 2025 easing and moderating borrowing costs should support momentum into 2026. For private equity deal activity, reflecting this improved backdrop, U.S. private equity activity improved meaningfully in the third quarter, reversing a brief mid-year slowdown. Deal value reached over $330 billion in the third quarter, which is up 38% year over year. Deal count hit over 2,300, which is up 11.7% year over year. Overall, the year is tracking towards $1 trillion in deal value and potentially exceeding last year's transaction count, which would make 2025 the second best year on record after 2021. Momentum is fueled by better credit availability, mega deals, take privates, carve-outs, and add-ons. The 2026 outlook remains constructive, but sensitive to inflation and policy shifts. On the exit front, U.S. PE exits improved in count, but softened in value in the third quarter. An estimated 464 exits generated over $125 billion in value, with value down around 30% quarter over quarter, but counts up over 22%. Several mega deals pushed year-to-date totals above 2024 levels. Sponsor-to-sponsor activity rose almost 42% of quarterly value, while corporate acquisitions increased in count but declined in value. IPO activity showed early momentum but was disrupted by the October government shutdown. A broader gradual exit recovery is expected as financing costs ease and risk-on sentiment holds. Corporate M&A pipelines are rebuilding. Sponsor-to-sponsor and continuation fund activity should remain strong, and the IPO windows may normalize by early to mid-2026. Aged portfolios imply elevated supply, with realizations led by scaled B2B businesses and resilient cash flow businesses. On the venture side, deal activity in the U.S. reached over $80 billion across 4,200 deals in the third quarter, lifting year-to-date totals above 2024 and marking one of the strongest quarters in years. Deal count continued to fall, highlighting widening capital concentration. AI-dominated activity, which was 64% of deal value, but only around 37.5% of deals, with 9 $1 billion plus AI rounds accounting for nearly 40% of quarterly value. Into 2026, capital is likely to further consolidate around foundation models, compute and chip infrastructure, agentic systems, and AI-native verticals. Rate cuts, improving exits, and corporate AI demand may unlock liquidity through non-AI early-stage companies will continue to face tighter fundraising until distributions recover. On to venture capital valuations. They continue climbing back towards 2021 highs across all stages, overwhelmingly driven by AI-linked companies demanding steep step-ups, shorter round intervals, and strong corporate participation. Elevated valuations should persist into 2026, but gains will remain concentrated in AI-aligned sectors, while non-AI companies face slower repricing and more selective capital. On the venture exit front, despite a $74.5 billion quarter, the strongest since the pandemic, VC exits remain muted due to light IPO volumes and weak post-IPO trading. M&A was similarly narrow, dominated by high-value AI acquisitions. A gradual sector-driven rebound is expected, led by AI, national security, space, and cybersecurity, as liquidity reopens selectively and IPO windows widen. From an opportunities and risk perspective, opportunities include a secondaries market on track to exceed $200 billion, improving liquidity and portfolio flexibility, and the rising prominence of growth equity as firms stay private longer, especially for accessing AI and other high-growth sectors. A stabilizing macro backdrop and rising IPO volumes further support improving exit prospects. On the risk side, a heavier reliance on continuation funds if inflation delays traditional exits, high valuations requiring robust value creation to avoid discounts versus financial engineering, and geopolitical pressures weighing on costs, growth, deal flow, exits, and LP appetite for US-focused strategies. Back to you, Greg and Chad, for private credit.
Thanks, Amy. And in one sense, some themes are the same, like you said. High valuations is something we've been talking about for a very long time. But if we truly do see improvements in liquidity, the IPO markets start to open up more. Those will be great exits for private equity investors.
Absolutely.
Okay, so Chad, private credit, the engine that makes private equity move, among other markets. What do you got for us?
Thanks, Greg. Again, just a reminder here, performance is lagged here. Performance shown through Q3, the benchmarks correspond to that as well. At a high level, private credit continues to deliver attractive returns to investor portfolios, though I'll note performance has moderated a bit here more recently. There's really two components to that: lower Fed base rates and broader spread tightening. Spreads are generally tight across credit markets. James commented on that in liquid credit. Same holds true here for private credit, and on an ongoing basis, seeing that kind of sticky spread tightening. There's varying degrees of that across the size spectrum for borrowers, but generally the theme has been tighter spreads across the board. Still, though, the relative spread premium relative to liquid public markets consistently remains, and that'll continue going forward in our expectation. Now, if we dig a little bit deeper here, we can decompose index returns to better highlight what's driving performance. Probably no surprise here, but the vast majority of returns generated in direct lending come from contractual yield to the portfolio. Importantly, though, there's been plenty of media headlines pointing to higher levels of stress, defaults across credit markets. We've generally not seen that in the data. You can see that here, the largely de minimis losses, realized and unrealized. For the last year, it's been about 61 basis points of losses. That's well below the 1% annualized long-term average. Now, that doesn't mean there aren't risks associated with parts of private credit. There's some general pockets of weakness. I'll point to healthcare as being one of them. But generally, broad measures of performance indicate that there's been consistent low losses. We're not seeing an uptick in credit watch lists. Things like that remain consistent and relatively benign at this point. Now, given that the majority of returns are driven by current yield, it's helpful that we look at this as a starting indicator for future expected returns. You can see here that yields moderated since the peak in 2023. Most of that's driven by the Fed rate hiking cycle and then tightening after that. Again, that is also contributed to tighter spreads. Every time the Fed cuts, though, you see the more immediate impact, while spread tightening tends to be slower, more gradual, as new loans at tighter spreads replace those that are issued at higher spreads in prior periods. Now, again, despite the lower yields, you still see the relative yield premium in private credit markets. at pretty healthy levels. And I would argue there's an implicit floor on how low spreads will go across private credit. Now, if we turn to portfolio credit risk, there's really two key metrics we closely monitor in private credit. The first is PIK interest, that measures the percentage of portfolio yield that is accruing but not paying out cash interest. And then the other one is non-accruals, and this is interest that's not being accrued, nor is it being paid out in cash interest. It's a good barometer or measure of stress in a portfolio and likely indicates defaults for those borrowers. From a PIK interest perspective, we can continue to see that PIK is elevated from pre-pandemic levels. I'll note a lot of that is driven by larger borrowers that have been afforded flexibility to pick a portion of their interest, generally reflective of the upper end of the spectrum in the market. Some lenders will refer to this as good PIK interest. Now, the flip side to that is when borrowers are picking because they need to, they have some stress or some issues going on with their business and they need that flexibility. In reality, though, we're not seeing a whole lot of the bad pick, for lack of a better term, and most of this is driven by the more flexible pick toggles that we're seeing, which has again been the case really since COVID levels. And if you look, the 7.3% level is roughly around the sort of post-pandemic average. Now, all things being equal, we'd much prefer cash interest over PIK interest. But again, just a reminder that we're not seeing that bad PIK interest component really pick up across portfolios. From a non-accrual perspective, these levels remain pretty low, benign, still well below long-term averages. So again, we're not seeing a big pickup in default risk, at least from a broader perspective. Now, if you turn to origination volumes, 2025 was lower than 2024, and a fair amount of that was tied to the period right after Liberation Day and uncertainty around tariffs. Still, though, 2025 is the second busiest origination year in the last 8 or 9 years. So all in all, a generally healthy year from an origination perspective. One key reason for that, though, is the consistent flow of originations that were used to refinance existing loans or for sponsor recaps to take some equity off the table and show distributions. Now, I would argue a lot of that has played out in the market, given that the Fed has reduced rates, should be more conservative going forward. You should see less of that refinancing volume. On the flip side, though, there's indications that M&A is significantly picking up, and we would expect that to be higher in 2026 relative to 2025. So net, you should see more origination volumes, but the mix of it could be a little bit different going forward. Now, as we look forward, another notable theme we're seeing in private credit is a broadening of demand and interest in strategies really outside of that core in private direct lending. Asset-based lending and specialty finance strategies were the most active in terms of new fund launches in 2025. We'd expect that to continue going forward. There's more momentum there relative to other areas of private credit. It's growing in prominence. It serves as a nice complement to direct lending, but I would caution being selective in the types of strategies and the risk exposures you're introducing there as you consider those opportunities. And just to wrap up with with opportunities and risks, I'll start with the opportunities. First is the expectation for higher M&A activity in 2026. Again, a portion of that may be offset by some lower proceeds for refinancing in portfolios, but all in all, we expect a pretty strong year in 2026 relative to 2025 and years prior. All-in yields, again, remain compelling despite lower base rates. They're attractive relative to public credit markets, and again, we see that as a strong source of returns in portfolios. Credit fundamentals remain resilient. They continue to hold up well in portfolios. Overall, we're not seeing significant losses or stress building. Lastly, on the opportunity front is this broadening opportunity set, particularly in the area of asset-based finance. Again, I think you need to be cautious in the types of strategies you're deploying into, but again, there are opportunities that nicely complement what you may have in your portfolio already. Now, from a risk perspective, again, we talked about tight spreads in a couple areas. Really, it's really all of credit markets. This will remain the case in 2026 and beyond. There could be some spread widening if we do see a massive surge in M&A volumes pick up here, but generally, I would say they're relatively anchored at these levels. On a related basis, we've also seen significant participation from retail investors in private markets. I expect that to continue to accelerate, and that could further intensify the supply and demand imbalance between dry powder and originations. Again, retail participation also brings with it additional risks in terms of investor behavior and reactions to headlines and market shocks. So it's something else that we need to keep in mind and monitor. Finally, Fed rate policy is another key focus here, given the floating rate nature of private credit. Again, the Fed is likely to be more cautious on rate cuts going forward in 2026, but there's this continued uncertainty and pressure from the administration that we all need to keep an eye on. And again, that just brings inherent volatility potential to portfolios. And with that, I'll turn it back to you, Greg.
Thanks, Chad. All in all, private credit continues to offer a compelling yield opportunity set for investors, and we think it will continue to have even more investor interest in 2026. And that brings us to the top of the hour. We hope that the last 60 minutes have been a great use of your time as you think about portfolio decisions and actions over the course of the next year. We're always here to answer questions for you. If we did not get your questions live today, we apologize. We will follow up offline. Everyone have a great rest of your day. Thanks again for joining us. Happy 2026.